Hi, I'm Marc, and on this channel I talk about Brexit and UK politics. And recently people talked about a trade deal between the UK and several US states, and I regularly read about a Brexit deal between the UK and the EU on financial services, and that was supposed to be agreed in June. I made a video on the first topic already, and today I want to bring some clarification to the latter. First of all, like with the US states, there is no deal. There is a Memorandum of Understanding again. The Memorandum of Understanding, the MOU on financial services regulatory cooperation between the EU and the UK, signed on June 27th in 2023, establishes a framework for voluntary regulatory cooperation between the two parties. It aims to maintain financial stability, market integrity, and investor and consumer protection in the post-Brexit era. Key objectives of the MOU are enhanced dialogue and information exchange. That means the MOU promotes regular dialogue and information exchange between EU and UK regulators on those regulatory matters. This open communication fosters a shared understanding of regulatory developments and emerging risks. And this shared understanding of regulatory frameworks means the MOU encourages a mutual understanding of each party's regulatory frameworks, acknowledging the potential for divergence in some areas. And this understanding helps identify potential risks and opportunities arising from regulatory differences. And there's supposed to be a collaborative approach to regulatory challenges. The MOU promotes a collaborative approach to addressing regulatory challenges, encouraging joint analysis of emerging risks and potential areas for cooperation. And this collaboration aims to mitigate risks and enhance regulatory effectiveness. And they want to explore future cooperation. The MOU serves as a platform to explore potential areas for future cooperation in financial services regulation. This, what they call a forward-looking approach, seeks to strengthen the relationship and address emerging regulatory issues jointly. The MOU establishes the joint EU-UK Financial Regulatory Forum as a platform for structured dialogue on financial services issues. The forum facilitates regular meetings between EU and UK regulators to discuss regulatory developments, identify potential areas for cooperation, and address emerging risks and challenges. While the MOU is a non-binding agreement, they say it represents a significant step towards strengthening regulatory cooperation between the EU and the UK, and there you already have it. But it would still promote a more constructive and collaborative approach to financial regulation, benefiting both parties and the broader financial system. And this MOU covers a wide range of financial services sectors, including banking, insurance, and capital markets, as an MOU. It provides for the exchange of confidential information between regulators, includes a commitment to regular joint risk assessments, and establishes a framework for cooperation on crisis management. And in conclusion, the MOU on financial services regulatory cooperation between the EU and the UK is a positive development, providing a framework for continued cooperation in a post-Brexit environment. And cooperation is essential for maintaining financial stability and protecting investors and consumers in both jurisdictions. The key difference between a Memorandum of Understanding, a MOU on financial services after Brexit, and a Brexit deal on financial services lies in their legal nature and scope. And I want to talk about the legal nature first and there about the MOU. It's a non-binding agreement that outlines a shared understanding and intentions for cooperation between parties. It does not create legally enforceable obligations. A Brexit deal, which doesn't exist, would be different. That would be a legally binding agreement that establishes specific rights and obligations for both parties. It would be enforceable under international law. The MOU focuses on promoting dialogue, information exchange, and voluntary cooperation on regulatory matters. It does not address market access or equivalence. A Brexit deal would cover a broader range of issues, including market access, equivalence, and dispute resolution mechanisms. It would establish a more comprehensive framework for the post-Brexit relationship in financial services. In summary, an MOU serves as a cooperative framework for dialogue and information exchange, while a Brexit deal would establish legally binding rights and obligations, including market access provisions. The only legally binding deal is the Trade and Cooperation Agreement, the TCA, between the EU and the UK agreed for the time after Brexit. The Trade and Cooperation Agreement between the UK and the EU provides a limited framework for financial services, primarily focusing on regulatory cooperation and equivalence assessments. It does not include any comprehensive market access arrangements for financial services providers. First, we have the regulatory cooperation. The TCA establishes a framework for regulatory cooperation between the UK and the EU, and this includes the exchange of information and consultation on regulatory matters. There are joint risk assessments and supervisory cooperation, and there is cooperation on crisis management and resolution. And then we have the equivalence part. The TCA allows for unilateral equivalence assessments where each party can determine whether the other's regulatory regime is equivalent to its own. If equivalence is granted, it can facilitate market access for certain financial service providers. And then we have to talk about this market access. The TCA does not provide any broad-based market access arrangements for financial services. Instead, it relies on a patchwork of equivalence decisions and limited grandfathering provisions for existing cross-border activities. Overall, the TCA represents a significant shift from the pre-Brexit arrangements for financial services. The lack of comprehensive market access provisions has led to increased costs and barriers for financial firms operating between the UK and the EU. So, the TCA focuses on regulatory cooperation and equivalence assessments. The market access is limited and relies on those equivalence decisions. And the TCA represents a significant change from pre-Brexit arrangements. And it has impact on financial services. There are increased costs and barriers for cross-border activities. Fragmentation of financial markets between the UK and the EU is another point here. And the uncertainty regarding future regulatory alignment must not be forgotten. And the future of UK-EU financial service relationships is open. There's an ongoing discussion on equivalence assessments. There is indeed a potential for enhanced regulatory cooperation, as we could see with the MOU, and there's a possibility of future trade agreements covering financial services, but unlikely. The TCA marked a new chapter in the UK-EU financial services relationship, and while it provided a limited framework for cooperation, the future of cross-border financial services remains uncertain and will depend on ongoing negotiations and regulatory developments. And there are still transitional periods in effect, so that we didn't even see the full impact here either. One of them is about euro clearing. I talked about this a lot of times already, but it's still important. The current transitional arrangement for euro clearing, which allows UK-based clearing houses to continue clearing euro-denominated transactions for EU clients, is set to expire on June 30th in 2025. This means that after this date, EU clients may no longer be able to use UK-based clearing houses for euro-denominated transactions unless the EU grants equivalence to the UK's regulatory regime for clearing services. The potential consequences of the end of the transitional arrangement are quite interesting. The relocation of clearing activities would be one. EU clients may need to shift their euro clearing activities to EU-based clearing houses, potentially leading to a loss of business for UK clearing houses and increased costs for EU clients. And the loss of access to UK clearinghouses could fragment euro-denominated derivatives markets, potentially reducing liquidity and increasing transaction costs. And of course, there's financial stability concerns. Disruptions in euro clearing could pose risks to financial stability, particularly during periods of market volatility. And the EU and the UK are currently engaged in discussions regarding the future of euro clearing. The EU has indicated that it is open to granting equivalence to the UK's clearing regime if certain conditions are met. And that's the point, because the UK has expressed concerns about the EU's proposed conditions, which would limit the UK's regulatory autonomy, as they say. The outcome of these discussions will have significant implications for the future of euro clearing and the broader financial services relationship between the UK and the EU. If equivalence is not granted, the consequences for market participants could be substantial. If the EU refuses equivalence for euro clearing, which I expect, it would have a significant negative impact on the UK financial sector. Euro clearing is the process of settling euro-denominated transactions, and London is currently the world's largest center for euro clearing still. If the EU were to refuse equivalence, it would mean that EU-based banks would no longer be able to use UK-based clearinghouses to clear those euro-denominated transactions. This would force them to either move their clearing activities to the EU or to use less efficient and more expensive methods of clearing. And this would have a number of negative consequences for the UK financial sector as well. First, it would lead to a loss of jobs and revenue in the UK clearing industry. Second, it would make it more difficult and expensive for EU-based banks to do business with UK-based banks. And this could lead to a fragmentation of the European financial market and a decline in the competitiveness of the UK financial sector. In addition, the loss of euro clearing could also have a negative impact on the UK economy as a whole. The financial services sector is a major contributor to the UK economy, and a decline in this sector could lead to lower economic growth and higher unemployment. Overall, the refusal of equivalence for euro clearing would be a significant blow to the UK financial sector, and I expect this to happen. It would lead to job losses, higher costs, and a decline in the competitiveness of the UK financial sector. It could also have a negative impact on the UK economy as a whole, as I said. And if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.